Welcome, everyone. Very good morning to the audience. While standing there as all the panelists were being called, I was looking at the pictures being displayed, and I've known all of these guys for many, many years. I could realize that all of these pictures are half a decade old, given that this is next gen. I think strategically that is what was put up. Uh, Okay, to discuss capital in real estate, I don't think one could have asked for a better panel. Now, before we deep dive into sectors and strategies that all of them are chasing, just zooming out a bit and looking at the calendar year of 2025, it was a historic year for India. Residential sales remained robust, strong absorption on office, almost 80 plus million square feet, strong absorption on logistics, a lot of capital flow, institutional capital flow, as per our year-end report, almost $10 billion, dominated for the first time largely by domestic capital. So I think all the macros were in place, and I'm sure all of us walked into 2026 with a lot of positivity. And then a certain geopolitical event happens. Crude is now at 120, rupee is depreciated by more than 5% in as many weeks. So to zoom out and my first question, and Shravan, maybe you can start. How are your boardroom conversations looking like these days?
Thanks, Nishant, for calling us old. I think that was a good start. But boardroom conversations, I think the good thing is everybody is very keen to invest in India. So that, I think, is a pretty good baseline to start from. Having said that, it's a bit of wait and watch, both on the buy and the sell side. It's pretty critical for volatility to settle before people start making large commitments again. Not from a macro standpoint, but more from a, I'd say, smaller pricing standpoint to see where things are going to settle down, and then sellers will be willing to transact at those prices. So that's where what we are hearing today.
So, Shashank, if I can bring you in, do you concur that it is just that the timing of deployment is more a question now and fundamentals, long-term view remain intact?
Yeah, look, I think I agree with Shravan. We've always had a very long-term view on India, and we've been here since 2009. I think Blackstone's also very similar. A lot of these organizations have been around in India for a few decades now. We've invested through cycles, right? We bought Leela hotels when hospitality was out of favor. We bought massive office portfolios during COVID when everyone was talking about work from home. So we've invested through cycles, we've invested through volatility periods. I don't think it's a matter of timing in terms of whether we deploy or not, whether we believe in the structural tailwinds of India or not. I think it's a matter of pricing, as Shravan said, which will shake out. So I think volatility is more pricing related, and we like to invest in sectors and assets that are more durable than just thinking through what the macro headlines are saying. So we like to think about quality, we like to think about the cash flow profile, and you have to be a bit contrarian ultimately, right? You can't only invest based on popular sentiment of what's good, and investor psychology is kind of faulty in that sense. When everything is going good, people want to buy. When everything is going bad, people are typically wanting to sell, and it's generally the opposite. When things go on sale in other aspects of your life, you typically want to buy things, right? So I think it's a function of being disciplined and keeping your emotions in check.
Interesting. And if I can bring you in times like these, and as I mentioned, particularly on rupee, right? How does underwriting change for foreign investors?
Sorry, I think underwriting generally, not just from a rupee perspective, but in the immediate short term, given where we are with what's happening in the world, and you mentioned that we have a geopolitical event this year, but I think the last 18 months have been riddled with geopolitical events. We had tariffs, we had a skirmish even last year with Iran and Iraq in Israel. But I think we have to, rupee is definitely one part of it. From an Indian context, if you think about it, a lot of your revenues, let's say in the office sector, one could argue that they are more USD denominated. So it's not, because most of the occupiers think dollar terms. Costs, some part of the costs are dollar denominated because of the import materials and energy related prices, but otherwise they're largely rupee denominated. I think for capital providers who are focused on USD denominated returns, the last 3 to 4 years have generally been difficult to look at India from a dollar return perspective. A, because opportunities, in the Western markets have been pretty good from a dollar return perspective, and unless you are doing a lot of opportunistic or value add opportunities in India, dollar returns are difficult to underwrite. But yeah, I think it has become more of a conversation. Just earlier, Suresh and I were talking about how the hedging costs for investors have gone up significantly just in the last 3 to 6 months. And these costs used to be sub 2% till about a year, 8 or 18 months back, and I hear they're more than 4% now. Hello. So, I think what that means for the Indian market, I think like Ashank was saying, the timing of the deployment or how investors are thinking about investing in the immediate term may go through a rethink, but structural trends and structural attractiveness of the market remains very strong and intact. And if you actually think about the USD INR trend over a long term, it remains within the 4 to 5% long-term trend. We've had periods where it's been more stable, and periods like these where we've had very spiky, inflations. But structurally, the market remains very strong, and one has to tide through these micro cycles, which is for any business.
So that's interesting. I think the currency volatility is something that foreign investors have accepted when it comes to India, and it is an acceptable risk on underwriting.
I'd say that different investors have different appetite for currency. We have a lot of investors who don't necessarily look at a USD related return, but a lot of American and European investors would look at a dollar denominated return. And they may choose to stay away from the market for some time. So I wouldn't say that it doesn't play into the underwriting. It definitely does. But timing is what matters more.
Got it. Thanks. Suresh, if I can bring you in. Do you think situations like these create more opportunities to jump in rather than being a fence sitter and observing for things to settle down?
Thanks, Nishant. So these situations are perfect for us, right? This is what we wait and look for. We look for dislocation in the market. We look for opportunistic returns. And that's the reason why, we do a burst of investments and then you kind of just hold back, because once the market heats up, there's more capital. And I think last 2-3 years, there's been, the sector itself has been performing so well, so there were not too many opportunities to kind of put opportunistic kind of capital on the debt side. I think on equity, we don't do that much of equity. So these are perfect. The only thing I would caution is, I think as one of the panelists said, it also gets compared in terms of relative value, right? So you could be looking at a great opportunity here, but on a USD basis, the committees do look at what is that they can get in Europe and US, because some of those markets also are getting dislocated because of this energy and all that, right? So that's something you have to kind of get over and get people comfortable. But otherwise, I do think these kind of things provide a lot of opportunity for funds like us.
Understood. So given the macro environment, the fundamentals doesn't change. One is long-term in India, and these situations do create opportunities. So moving on, what thematic bets are you placing? So what are you seeing on your deal pipeline right now?
Sure. I think a lot of the pipeline in the last 1-2 years has been special situations, M&A, people wanting to buy their joint venture partners out, people wanting to list, so need some capital to kind of consolidate all the minority interests. These were some of the conversations which we are having, and obviously some developers who are looking for a lot of growth or trying to acquire things out of NCLT messy situations which banks wouldn't really finance them or NBFCs wouldn't. That's largely been the pipeline. I think if this dislocation actually materializes, it's too early, right? We haven't seen, energy prices have not really translated in India. If this does go down the direction, and if there's a broader slowdown, right, in all the sectors, right, especially residential, I think those will produce opportunities for us to do some of the financings we should do earlier, which is residential, developer financing, trying to get them to the last mile, or people having milestone payments to make to all the land auctions. Ankur and I were chatting about that. At various authorities, people have bought land from MMRDA, bought from Noida, bought from like various government agencies and private parties. So those opportunities come into play. Today, I think this, because of the performing underlying residential market and generally the property market, right? A lot of that capital is not out there looking for funds, right? So
basically, things that are going to keep us up at night more often going forward is where Suresh will see opportunity as well.
Yeah, he's been smiling a lot more these days. Shravan, if I can bring you in. You've, at Blackstone, built one of the largest and one of the most diversified platforms in the country. The scale at which you're operating right now, and taking the current situation also into consideration, do you think there are still platform level opportunities, for instance, Bagmane, Kolte Patil, what you did, or this will once again require more asset level situations and, start building a portfolio, maybe basis that. So does the country still offer enough opportunities at an asset level? And to the current situation, do you see that maybe that is the way going ahead?
Okay. Let me first hit the opportunity. I think the best thing about India is there's always opportunity, right? You can be creative, you can do pretty interesting things. We started, like Ashank mentioned, call it about 15 years ago, investing in one business. Today we are across 6 sectors, have, call it close to 10 platforms across these sectors. So you can always do new stuff. We didn't do residential, we got into residential last year, created retail out of thin air, and so on. So opportunity is pretty real, no doubt about that. Platforms, I think platforms are great to get scale quickly. So they're pretty good for people like us who are looking to deploy large amounts of capital in themes we like. Having said that, we always remain open-minded where we see good economics and good execution teams to create platforms, right? And we've very successfully done that. So most of our very successful platforms, for example, Lumina on the data center side, Nexus on the retail business, and Horizon in warehousing, were all created from scratch. So I think it will be both. As the opportunities come, will this dislocation create opportunities? I guess. But, like I think most people here were saying, it's a bit of wait and watch today. So we'll see where this shakes out.
And Sean, if we could stick with you for a moment. And as you just mentioned, over the years, you've created these portfolios and exits have come through public markets. And historically, most foreign investors and other global markets that they play in, residential has been built to lease. However, you guys adopted a different strategy, and with Kolte Patil. What's the playbook there? How will that look like in the next 3 to 5 years?
Yeah, globally, for rent, residential is pretty much one of the biggest asset classes out there. In India, just given where residential rental yields are, as against mortgage prices, it's pretty hard to make any kind of returns work. And given we actually have a very large presence in residential globally, and we were very keen to start something in India. And Colte offered us a very unique opportunity. This was listed company, had 65 million square feet of development potential, unlevered company with enormous capital to grow. So this was, like I said, a very unique situation, decent brand, and it really needed a bit of a touch to scale it up, to take it to the next level. And the business plan here is pretty simple, is scale this business, leverage the brand, grow, Pune is our home market, we're pretty stable, steady there, but grow into other cities, right? And over time, do this sensibly so that, you're really solving to project level margins. The idea is not to be irrational and chase sales for the purpose of having a valuation. It's about building a business. And we're very optimistic about what we're seeing there. So,
One more question,
yeah.
Shravan. On this, and I'm curious to understand, uh, if you look at the earnings multiplier that a lot of real estate developers, particularly on residential, are getting, right? The aggressive ones are where they have a pan-India sort of presence, and that helps to diversify the revenue pool as well. Are you seeing opportunities where, let's say, a particular geographical based dominated developer uh, who has listing ambitions, but you clearly realize that that may not be a long term sustainable journey just with that revenue profile or regional dominance? Are you seeing situations where some of these are approaching for a reverse sort of listing or merging into the listing entity?
Yeah, sure. I mean, people will be opportunistic about this for sure, right? The biggest trend I think that's happened in real estate in our business across every asset class is just consolidation, right? Whether it is consolidation on residential, commercial, retail, warehousing. Brookfield did a fantastic trade on Leela, right? Just consolidation is the reality, and therefore the big are getting bigger. To your question, are smaller developers looking to list? Many are, right? And if the IPO market shuts, you will certainly have conversations around them approaching people for a reverse merger or a reverse listing. So it could be reality.
No, interesting, and it's a curious space to watch out for. Now that you brought Leela up, if I can get Ashank in. Uh, Ashank, Brookfield has built a tremendous business in India. Interestingly, you've played across the cycle. You've gone out, acquired core. You've built, and developing in this country has not been easy. Then, of course, acquisition of Leela, and it's gone public now. So, if you were to deploy incremental capital today, which are the sectors, areas that you'll go really deep in, and which are the sectors you will maybe want to pull back a little on?
I would say, again, I think sector-wise, when we think about where to invest, it's we focus on the fundamentals, demand, supply, where the demand tailwinds are structural, where the supply is underbuilt. We don't think about it too much on a macro level in terms of headlines of what's happening overall in the globe. We like to buy good quality assets or build good quality assets. The macro is, of course, important context, but we are very much focused on the demand-supply fundamentals for that particular micro market and that particular asset class as well. So I would say that, look, I mean, we would lean in across where we are already present, as well as other sectors like warehousing, logistics, residential. India is structurally a very underbuilt real estate asset class, right? For a $4 trillion economy, you have less than $50 billion of real estate. In the US, it's $28 trillion of GDP and $20 trillion of real estate as an asset class, right? So the investment thesis is that gap, right? And we would definitely lean in across sectors in the country. What we avoid is commodity. where there is nothing for us to do, or it's easy to replicate from a barriers to entry standpoint. We like to play in asset classes or assets where there is something operational for us to do, and not simply think about it from a macro, exit standpoint and rely on an exit multiple, because that can vanish very quickly. So that's generally how we would think about which areas to focus on.
And coming on to hotels and Leela in particular, when you're looking at scaling this up, more opportunities, buying or developing, your underwriting is primarily driven on what sort of operating cash flows will get generated, or there is a big bet on what sort of real estate also we are talking about. And Leela, such experiential asset class or hotels that you've created. So how do you wear that hat when you're looking at Leela expansion?
Leela is slightly different, I would say, because we have a very ultra luxury positioning in the brand. So the real estate matters, the operations are fantastic. The EBITDA margins are one of the highest in the country, if not in the globe. So I think operations obviously matter a lot. But just taking a step back on hospitality in general, I would say real estate is the foundation, right? So in everything that we do, the location and the real estate is obviously a big driver of how the returns will pan out. But operations are equally important to create that alpha, right? So you can buy a very good, high-quality location, and if your operations are very subpar, you're not going to be able to compound the returns. Your location might still be able to drive a lot of demand, but at some point, you're going to be able to, you're going to lose market share to someone who's operating their real estate better. So operations are very important in everything that we do, not just in hospitality, I would say across asset classes. It's really what allows us to drive the alpha versus other players.
And are you seeing hospitality finally emerge in an institutional grade asset opportunity in India? It has historically been very opportunistic, cyclical. It would you see more and more strong investors approaching it and scaling it up further?
You've got the two biggest investors in the country liking hospitality as a sector. So I think, yeah, I think it's definitely re-emerging as an institutional asset class. Look, again, demand supply, right? The fundamentals in hospitality for the longest time, have been favorable now, where supply has been muted, capital has been expensive, so it's been very selective in terms of what hotels have been built. Some of that is being challenged right now in the last year or so, where there have been a lot of headlines in terms of new hotels coming up and new supply coming up, especially in tier 2 and tier 3 markets. And that's something that I would watch out for fundamentally, because you want capital to stay disciplined. But as an asset class, I think, look, structurally we are still very undersupplied in the country for where the demand is growing. And as long as we're picking the right locations, as long as we're picking the right operators, and we have a real business plan around it, I don't think you can go wrong in that asset class from an investment standpoint.
Right. Thanks for those insights, Ashank. Ankur, if I can bring you in. You've built a business around partnerships, both domestically as well as with a lot of foreign investors, particularly a lot of Japanese in the last 3 years. And the strategy has been to come in early development. And development in India obviously sees multiple cycles. How do you balance that out, expectations from a domestic partner, expectations on the foreign partner, and then multiple cycles?
Yeah, I think that's a great question, Nishant. And I think, unfortunately, in India, predicting timelines or predicting the pre-development phase with approvals has always been a challenge, and we think it's going to continue to remain a challenge. So a large part of our role as developers and operators, so the two partnerships or stakeholders that you mentioned really talk about the dual role that we play. A, we are an operator on the ground, and B, we are an investment manager with our capital partners. And yes, managing expectations across is a root, I mean, it's very important, but it's ultimately rooted in risk management for us. So my biggest role when I'm looking at deals or when I'm underwriting transactions is, of course, alpha generation and returns is one thing, but risk mitigation and risk management is the number one priority for us. And I think our experience in the country of more than 20 years really helps in that. We have strong on-ground teams and experience across cities and sectors. But I think more than that, it's really focusing on the key risks in a lot of detail. So for us, costs and schedules are extremely detailed, and we don't compromise on those. As much as our partners may dislike how deeply we think partners, local partners, it's very important to have long-term alignment on incentives. I mean, we need to be aligned on the long term. So structuring that partnership, playing on each other's strengths. So if my partner has the strength to be able to minimize my pre-development risk, then I'll leverage on that with him and structure a trade which ensures a win-win for us. And I think we've seen a lot of success with that, and we'll continue to adopt that model going forward as well. For capital partners, I think capital partners understand risk. They are not novices, or they don't expect to come into a country like India and have everything perfect. What they crave or what they seek is clear communication and a clear thought process of how you're underwriting the risk. And for us, that is a large part of what we do well. And yes, we've done this not just in India, but across the world. So yeah, I think that's how one thinks about risks and communication with stakeholders.
Understood. And do you believe India continues to be one of those markets globally where development delivers that alpha return?
Oh, absolutely. I think India is probably, if I speak of office, for example, I think India remains one of the development spreads in India, what it costs you to build and what you can exit at, they remain to be one of the highest in the world. And that is really a strong attraction for us to, do a lot more development in office, because the margin of safety is pretty strong. And that can help you tide over volatilities in the short term as well. But just taking a step back, I think overall the structural trend for India remains very strong, as my fellow panelists have observed, and opportunity is abundant. I think we are always focused on what we can execute well. So we've remained true to the two sectors that we like, which is office and residential. But opportunities everywhere, and there is definitely a lot of scope for alpha generation, also primarily because we are significantly undersupplied from a quality stock perspective, be it commercial, be it residential, be it other asset classes. So from that perspective, an institutional way of delivering quality products, there is an even larger demand than the broad macro trend.
Interesting. And are you still in your deal underwritings? Are you still seeing sort of early teens yield to cost? Are you able to crack deals there? I mean that is where then the alpha comes in, right?
I wouldn't say early teens, maybe early tweens, but I think there's always pressure on costs. You know where the land prices are. I think there is a lot of focus right now when we are underwriting as to what the costs look like in the next 2 years, because a lot of what's happening may not be fully priced into the cost yet. So I think we are looking, yields will remain probably in the early double digits, but even if it is at 11%, for example, and you are a better you can guess better where one can exit a quality product today at, but that spread is still 3.5% to 4% comfortably.
Agree, I think, and that's a healthy spread. Suresh, if I could bring you in, barring the current environment, if you look at the last 4 years, residential sales have been strong, absorption has been strong across asset classes. Given that, do you think solution capital still remains relevant, or the opportunity set has narrowed tremendously?
So last couple of years, it's been very narrow because of the performing sector, right? So you need an event based for some of these solution capital or a regulatory arbitrage. These are usually the two determinants of these kind of capital solutions. So I think after the NBFC crisis, and I think COVID basically tipped everything over for resolutions. So you had a slurry of resolutions which happened between, I would say, 2020 to 23, 24. So I think, and then the market then kind of came back strong. So I think some of those opportunities are there. There are a few which are still there, but they're a lot more messier, and it's difficult for institutional investors like us to kind of tackle. So we'll have to kind of look at some large developers whom you can fund to tackle those. So those situations are still there. But yeah, last couple of years, I think for solution capital has been a challenging market.
Noted. So, just given the time, I guess we'll move to my last section. We are sitting in the Next Gen event, so hopefully some takeaways for everyone. And maybe we can start, Suresh, with you, and then, can take turns at it. So my first question is, would you back a great location or a great business plan with an average developer, or maybe an average opportunity but a great developer?
I would say great developer with an average location. Because for me, for us as a philosophy as a firm, it's return per unit risk. So risk is very important. And we do believe, and I've seen it myself over 2 decades of investing in India, that if you bet on the right developer, even if your location is not a great, he's produced results. And vice versa has happened where we had the best of the locations, but they were not there in terms of execution. So that to me is any day.
Raman?
Yeah, 100% agree. There is no substitute for having the right partner on the ground. Yeah, simple.
Chan?
We are a great developer, so we'll go for the location. But no, I mean, like fundamentally, you can't have a great location and average execution, or a poor execution, because then you just have a great land parcel, right, with a lot of other issues. So fundamentally, the partner or the execution capabilities is equally, if not more important, than the location only.
Yeah, I guess for me the answer is neither. I think you can't, one cannot compensate for the other. And more than a partner, more than a developer, I think it's a partner, because, we are also developers. So I'm less concerned about development, but having the right partner is important. And, poorly executed great location can be a disaster as well. So location is always paramount, but with the right partner is also key.
I guess 2 messages: operating excellence, focus there, and the right partner. Okay, moving on to my next question, and Ankur, we can start with you. What is the single biggest risk for the industry that you see over the next, let's say, 18 to 24 months?
Yeah, I think right now, given where we are and what's going on in the world, I think from a impact on the cost perspective, like Suresh mentioned, what is happening is not fully priced into the Indian market probably. I mean, we could see a rubber band effect on the Indian economy. That one needs to see how it plays out, how capital is thinking about that, and every capital, could have a different view. I think all of these will be very difficult to predict, but these will be key questions on one's mind, and a lot of these are unknowns at this stage. So this itself is a big risk, and one needs to very carefully look at all of this in the next 18 to 24 months.
Chan?
Yeah, I would say just maintaining discipline, and I think you have to cut through the noise, and there's a lot of noise right now. So The biggest risk I see is people losing that discipline and and setting, benchmarks in the market that are difficult to then, creating more noise and more ambiguity. So yeah, discipline is what I would focus on.
Huh?
Yeah, I won't say risk, but what I'd watch out very, very closely is demand. It's the single most important thing we track, whether it is residential, uh, commercial, retail, whatever logistics. That's the single most important variable we track to see how trends there are evolving. The other meaningfully smaller risk is cost. With oil prices being where they are expected to go up, steel prices jumping meaningfully in the last 6 months, uh, you know, project margins need to be evaluated pretty carefully, particularly as you underwrite these things going forward. So those are the two things I just watch out for.
So Nishant, I would look for the translation effect, right? How these kind of things pass on into commodities and all that. The other thing I would also be keeping a close eye on is this whole AI and its impact and what it does. See, a lot of us are invested in properties and stuff which derive a lot of demand from the IT sector, and there are some connections to it. There's a second order demand and all that, right? So, and some of the cities are basically built on that, right? Like, you see Gurgaon, you see Pune and all that. So, or Bangalore, Hyderabad. So I think that is something to be closely watched. I think so far it's not really impacted the Indian market, but I think you're seeing more announcements these days about, what might happen. So we'll have to see if that actually gets a consumer to shut down and the sentiment gets impacted. So, and what will be the rolling effect? Because some of these cities are dependent on they're the primary demand drivers, right? People spending the money, young guys and all that. So this is something I'll keep an eye on.
I was waiting when someone was going to bring AI up. And no, and thanks. So, cost, discipline, margins, and of course, overall what happens with AI. So, my last question, and Suresh, if we can start with you and then can come to Ankur. Since it's a next gen event, what is, with all your experience now, what is that one advice that you will give to a 10 years younger self of you?
I would just say there's no substitute to hard work. Just work hard and think smart.
Raman?
Yeah, discipline, execution, build your career step by step. You don't reach the top just by jumping there straight, right? And even if you do reach the top by jumping there straight, you won't know what the hell to do. So take it step by step and keep doing the best that you can at every stage.
I would say pack your patience. समय के पहले और नसीब से ज़्यादा कुछ नहीं मिलता है. So just pack your patience and I think India has always rewarded investors who are patient and not moving based on headlines, and it's something that we sometimes lose sight of because everything has to happen as of yesterday. But just pack your patience and manage your emotions.
Yeah, I think when you're younger, you're more obsessed with the deal and numbers usually, and that's required as well. But I guess keep a longer term view when you're looking at things, and think of all your stakeholders and your shareholders when you're thinking about a deal, and try to think through their pain points and how you're solving those as well. That is important.
That's some great advice coming out. I'll just add, real estate, we purely see it as a return on capital business, as most businesses. I just also feel in our country we need to start thinking about it being a return on time invested business as well. And I guess I would like my 10-year younger self to say a lot more no to a lot more opportunities that I did by then. So yeah. So thank you, gentlemen. Great insights, as always.